Hello and welcome. Thanks for joining us tonight. I'm Chris Brady, Yale College class of 2005, and I'm also a co-founder of Accelerate Yale. We're a shared interest group of global alumni and friends of Yale who are engaged in innovation, tech, and entrepreneurship. We're delighted to have this evening's webinar co-sponsored by Yale Fin and made possible by Yale Alumni Association. Before introducing our speaker, just a few operational items. To engage during the next hour, you'll find at the bottom of your screen 2 conversation bubbles labeled Q&A for submitting questions to Jacob, and chat for dialogue with other participants. This webinar is being recorded, including the chat component, and all participants are muted. This webinar will last 1 hour, and we'll reserve about the last 25 minutes for your questions. So without further ado, I have the honor of introducing Jacob Mullins, also Yale class of 2005. He's a founder, investor, and operator, and a great friend of mine. He's a partner at Shasta Ventures based in San Francisco. They're a 16-year-old leading West Coast venture firm. They're focused on Series A investments in enterprise software, SaaS, and cybersecurity. Jacob leads the firm's investments in SaaS applications and applied artificial intelligence, specifically computer vision. He's also invested in fintech, esports, AR, VR, and blockchain. And prior to Shasta, he was an entrepreneur, co-founder and CEO of companies in consumer products, Hoodia Products founded at Yale in 2003, in media, VentureBeat.com, and fintech at Exit Round. So, getting into the meat of our conversation today, obviously the global landscape has changed given COVID-19 pandemic, and with it, it has brought many challenges to the world, but also specifically to the venture industry. And so let's start it out by Jacob. Give us Shasta and maybe a West Coast view of kind of what's going on right now, and how are you responding both as an investor and as an operator, board member, etc.?
Great. Thanks for having me, Chris, and the Accelerate Yale group and everyone else. It's an honor to be speaking to you here from San Francisco, just past, 5 o'clock. So thanks for tuning in. To set the stage, let me introduce Shasta a little bit based on the stage at which we invest, and that'll help you understand where we like to, or kind of how we engage with our companies. But we consider ourselves kind of a traditional early stage Series A investor. Our office is on Sand Hill Road. We're 16 years old, so you can kind of consider us a traditional Sand Hill Road VC. What we're looking for is companies that have product in market, early customers, and are just at the beginning of starting to scale their business. So somewhere around between $1 and $3 million in revenue. That's the time at which we will invest. We'll invest between $3 and $10 million, typically leading the rounds, typically joining the board, and really partnering up with the companies for the long term. So that's to set the stage. Now, and we primarily invest in enterprise software. But because we're investing at the early stage, and oftentimes it's the first time when you institutionalize a board for some of these businesses, we have the distinct privilege of really partnering with these entrepreneurs one-on-one, and are oftentimes the first institutional investor in the company. And so in doing so, we develop a pretty strong bond and relationship with them. And in times like this, where there's a lot of economic uncertainty, that becomes really important. And our jobs actually really ramp up. And I can say the last 4 or 5 weeks for me working from home have been some of the busiest weeks I've had over the past 5 years being at Shasta. And that's because I've been on the phone with the companies, the entrepreneurs where I'm on the board. I've been on the phone with numerous companies across our portfolio, of which there's about 65 active companies. Really helping think through where we're at today. And so, where we're at today from a venture capital and startup perspective, you're seeing a lot written about the potential of some big V-shaped or quick V-shaped recoveries. We're actually of the mind that this is actually going to be a longer recovery than many are saying. We're of the mind that this is fundamentally shifting the way that consumers are interacting, the way that consumers are purchasing products, both in retail and in digital, that it's changing the way that companies work, the way that work is done. It's changing the way that companies, for where they're even spending money. It's changing travel. And we're of the mind that this is more than a blip, that this is a true function change in how people interact. And so what that means is that there's going to be a reset period until people figure out what is that new normal. So for us, what does that mean? It means we need to counsel our companies, and we work with our companies to be able to last through this time of change. And venture capital is really just subsidizing growth and the ability to kind of bootstrap revenue for time. So we invest money and we give the companies the time to be able to go and build a business model. Now, in a time when there's less money being spent, significantly less money being spent, it means that our venture capital dollars will or may go out the window a lot faster than we expect. And so what we've been actively doing over the last 5 weeks is really triaging our companies, and we can talk more in depth about that, but really thinking through how do we prepare our companies to last through this time period. 2, we've been thinking about how do we approach new investments. And then 3, how do we think about portfolio construction for companies within our portfolio and kind of a whole group so that our portfolio can maximize the amount of return that we offer for limited partners. Venture capital is a world where it takes 10 years for companies to be built. So from a temporal investment diversification perspective, venture capital is a pretty good asset class. None of the companies today are liquidly trading to our benefit, but we need to make sure that they can get there for 10 years from now. So we can dive into any of those sections, but that's a super high kind of intro and what we've been up to.
Sure. Thanks, Jacob. So let's take it one thing at a time. Let's focus on some of the advice that you've been giving your portfolio companies. You sit on boards. What are you telling your companies given, there's an exogenous shock? We don't know how long this will last. Obviously, it's different for companies that have a marketplace where it's completely shut down because of stay at home versus ones that are still operating, albeit in some limited capacity. So what is some general advice and maybe specific advice as well?
Yeah, perfect. So let me walk through kind of our planning exercise we've been doing with our companies. At the end, I'll share some links and some resources that are posted on our blog, but also we've been sharing directly with portfolio companies. But the first thing is not to totally freak out. Like, we need to take a breath and really plan multiple different scenarios for what's going to happen in the future. And so we're suggesting that our companies look at their operating plans, and the operating plan is essentially being the P&L cash burn over time into the future for the next 2 years. And most of those plans today have been written expecting the levels of revenue and growth that we've seen over the last 5 to 10 years, right? We've been an 11-year bull market. So most of the plans are planned for that. And so what we're saying is, okay, entrepreneurs, CEOs, it's time to replan for pretty meager days. And so we're saying model 3 scenarios. 1, where top line growth is 30% less than you'd previously planned. 2, top line growth is 60% less than you had previously planned. And 3, top line growth is 0. There is no new growth of revenue. And in that last scenario, consider that your churn, your loss of customers, may be 50%. So I'll note, we primarily, again, work with subscription business or companies with subscription business models or SaaS software. So recurring revenue is kind of the model that I'm referring to. But that same scenario would work probably for any business. And so once you have the set of those 3 scenarios, kind of -30, -60, and then 0, that's one case. The next thing is to look at your existing customer and revenue set and go through customer by customer. And that will work less in consumer businesses, but for enterprise B2B, you can go line by line, customer by customer, and try to predict whether they're going to stick around or whether they're going to cancel. Try to put yourself into their mindset, have your account managers reaching out to those customers, and even proactively reach out to them and ask them, how are you guys doing? How's the economic world affecting you and your ability to continue purchasing our software? Is there anything we can do to help? One, it's just going to be a great customer experience, reach out from you. But two, it's going to help you forecast and really choose which plan you're going to need to go on. And so once you get a sense of who's going to be canceling versus who's going to be sticking around, you'll be able to build and move towards another model. Now, another exercise to go through is actually looking at your existing product roadmap. And again, the product roadmap has probably been built for a world where you're growing 200 to 300% a year. And that's the companies we work with. Well, guess what? If you're growing less than that, if you're growing significantly less, your product may be off. A lot of products in bull markets are focused on helping companies save, or helping companies continue to grow, gain more revenue. And in a downturn like this, what we're going to see is companies want to save money. And so how can your product strategy actually be shifted? Your marketing strategy, your positioning, even potentially your pricing, be shifted and sold in a way that helps companies save money. A lot of that can be a product and a marketing experience. And so once you have those kind of three pieces, which is your plan scenarios, what customers are going to change, and then potentially what new products can you shift to augment your revenue, now it's time to augment the plan or implement the plan. And so as you think through implementing the plan, try to forecast which one of those you're going to do and figure out how you're going to get 12 to 18 months. And as a part of that, there will probably need to be layoffs. There will probably need to be salary reductions across the board, and potentially raising venture capital. And we can talk about how you would raise in this market. But that's kind of the operating plan and exercise we're having our companies go through now.
Sure. So it's very typical in Series A raises that the companies try to raise enough capital to at least get them 18, 24 months. What's happening to the companies in your portfolio that were going through that process now or have, say, less than 12 months of runway? Obviously, they want to preserve cash. That means reducing overhead and things like that. What other advice can you give for companies to position them to have the most successful raise, or at least a less painful one? Yeah,
really good question. So as portfolio managers, what we did is look through our portfolio of 65 active companies and look at which companies were in that situation. In our current fund, there are 5 companies in that situation. And they were the first 5 that we did that planning exercise with. And, I probably spent a full day with each one of them, walking through all the plans and seeing where they're at. And then we realized, okay, well, most of these companies need to fundraise. And in fact, 2 of those companies were in market fundraising. They were in final partner meetings with some very well-known firms here in Silicon Valley. And the Friday, 2 Fridays ago, they got a call that said, no new companies coming into our partner meetings. We're putting a hold on new investments. And so that took the outside lead position out. And we basically have brought every single one of those companies in to pitch to our partnership for an inside round. Now, as portfolio managers, this puts us in a really tricky situation because we need to maximize return and reserve dollars for our investors. And so in some cases, we're having to choose between some companies. And it's a really sad situation that we have to go through, but unfortunately we do. In one of the cases, we led an inside round. We saw that by leading a round, we would be able to bring in outside capital. And so I would say that's probably the most effective way of doing it right now is, as I've seen, at least for Series A and up, most fundraisers are on momentary hold. We can get into the fundraising environment actually, so I'll kind of pause on that. But I would say go to your inside investors, figure out how much money you can cobble together from the inside. And then, usually CEOs will have other investors and angels and other groups or corporate and strategics hanging around the wings, and see if you can get an inside term sheet, which will then catalyze a lot more of a round to come together. And so that's what we did. We led a round with a $2 million term sheet, and are bringing in between $2 and $3 million more dollars into that company. And that's also alongside that company reducing burn, cutting some headcount, cutting, all kind of optional expenses and going forward.
So understanding that if you have to take any outside capital or even probably inside capital at this time, it's going to be more dilutive than 3 months ago. Are you seeing companies rethink their go-to-market plan, their product development spend, maybe pare back their ambition until there's a normalization? And do you think that companies will be rewarded for that or penalized?
Yeah, 100%. I think it depends on the stage at which you're raising money. As an earlier stage company with early revenue where we are, your valuations were less inflated to begin with. If you're a late stage growth company and potentially in the hundreds of millions of dollars of valuation, there's a lot of companies out there with 20x forward-looking revenue multiples that today those are going to get pretty chopped down pretty quickly. Most of the companies we're investing in are between 20 and 60 million pre-money valuations, which are more closely tied to revenue. And so what are they doing? That company example I gave you, the one that we just did an inside round on, when they were out in market, they had a fundraising plan to raise twice as much and a revenue plan that got them heavy growth, growing by 300% this year, another 300% next year. So almost 9xing revenue in 2 years. When they came in to pitch to us, they had entirely rejiggered their plan. They had basically put all of those original plans off to the side and built from the ground up a COVID analysis, which was, what do we need to be able to sustain the business and get to a good, potentially even cash flow break point in 2 years if we can raise this round. And that was really important for us to see because we want to be realistic about it. Like, a lot of these companies, this may be the last money that they raise for the next couple of years because fast growth is not happening here. So you need to have good economics and fundamentals. For them, the round ended up being a very slight uptick. It was just almost flat, but a very slight uptick. I have seen and heard other stories from other entrepreneurs and investors out where down rounds, especially if the companies are in the hundreds of millions of valuation, down rounds are very common. Basically, as an investor, what we want to be doing is setting the company up for success, so that in 2 years, when they've lasted through this market and they have some moderate growth, we want the company to be set up for a new financing. And so if the post-money valuation of an inside financing today is too far ahead, that's going to scare away investors with moderate growth in 2 years. We're not going to do that. And so we want to reset the company's valuation to be able to be ready for a fundraise in 2 years.
Gotcha. Are there
one other thing I'll mention we can talk about later is the CARES Act and the PPP stuff. That's another way of bringing in capital, but we can do that later.
Sure. Well, I guess we can address that now. I mean, part of your role as a director is to help the company. And right now, what do companies need? They need to survive first and foremost. They need access to capital if they're not properly capitalized, and obviously try to retain as many employees as possible. That's where the PPP comes in. And so how active are you guys in engaging your companies and helping them go through that process?
Yep. Great question. So I'd say of the last 5 weeks, was it the 5th week? Of the last 4 weeks, the first 2 were focused on that planning exercise I talked about. The most recent 2 have been focused on helping companies navigate the CARES Act and PPP. There's a few stimulus packages that enabled companies to defer payments on debt so a number of our companies are taking advantage of that. But more specifically to PPP, it's moving really quickly, and the cash is going out very quickly, as we've seen in the news, but the perspective of whether or not companies should take capital is also moving very quickly. So a week ago, almost all startups were planning on taking PPP, applying at least. The main startup banks like Silicon Valley Bank, First Republic, Wells Fargo, Chase, were all preparing to take applications. In order to do that, there was a thing called the affiliation clause, which was basically many of you are probably familiar with it, but could an investor exert undue pressure on a company, in which case it had to be lumped in, and thus the company was not open for PPP. A lot of that was waived, was kind of at least the Affiliation Act was waived. Where we ended up coming out at the end of last week. So the beginning of last week was everybody should apply. The end of last week, actually everybody put the brakes on that, and we said, hold on, let's make sure that the companies that we're investing in actually need this money. And so it was much an ethical question as it was an economic job stimulus question. And it kind of came from the banks, the lawyers, and then ultimately the management teams, who looked at the meaning and the spirit of what PPP was written for. And we see that it's mainly written for preserving American jobs, either stopping layoffs or enabling companies to hire. And so we looked at our companies and we asked all of them to report into us who was planning to apply for it. Then we looked at their cash position, their burn rates. And if they had more than 12 months of cash, we were basically saying, we were recommending that they do not apply. And we were recommending the companies that do apply are companies that have less than 6 months of cash, where COVID has been and the economic shutdown has been a drastic, meaningful problem for them, and has drastically reduced their revenues. And in those cases, we are asking for legal documentation of their application and then their operating plans, both the operating plan without PPP and with PPP. And if we see that there's a delta there and PPP is actually meaningful in retaining jobs, then we'll recommend and we will vote as directors of the board that they're able to, that we recommend that they apply. Now, in some cases, we don't control the company, we're a director. In some cases, companies are applying where we are on the board, and we may dissent in a case where we don't agree with that. And we've let our companies know that in some cases we will dissent in that and vote negatively as a board member. But it's ultimately up to management whether or not they're going to apply. So for folks out there who are raising money or thinking about PPP, there's some great resources from a lot of the law firms, specifically Lowenstein and Cooley, who we've been getting a lot of information from about kind of this legal ethical question of who really needs it. And what they're saying is there's a good chance that regulators and auditors will be coming around in the next 6 months to look at all of the applications. And if there are people in there that shouldn't have had this capital, that there will be examples made of companies who flaunted the system, potentially who are fraudulent. And as upstanding citizens and Americans who want all small businesses to be good, I want to direct that capital towards businesses where it's most effective and can drive jobs.
Great, thanks. I think it's probably a good segue into investing in new opportunities, given that this is going to drastically alter the landscape. Look, the NASDAQ was basically back where it was in December, but we've lost 18 million jobs in 3 weeks. How do you start to think about valuations when you can't really mark to market? Yeah, great question. I don't know. I mean, I'm not a public market investor, so I can't really comment on any of that stuff. But how we're looking at it from a venture capital perspective is we're just not doing new investments right now. We're meeting companies, we're looking at new companies. I think the big problem we're having right now is understanding how do you have the conviction and belief in the entrepreneur and the person. How do you gain that without ever meeting them physically? How do you gain that without, typically I would go to the team's office and see everybody at work and have lunch with the whole team and have dinners, and this can all happen in a short period of time, but how do you do that without over Zoom? And I guess I think we'll get there. I think social proof is going to be a big part of new investments in this market. So if we get referred to companies who come from seed investors, angel investors, co-investors who we're really comfortable with, who we do a lot of deals with, who we like their perspective in the market, I think that will help accelerate new investments. But for us, we're kind of putting a hold on it until we see what's going on in the economic markets or in the public markets. And it's less related to the public markets. It's more related to helping us triage our own portfolio and then think about the future.
The last thing I'll say on that is I'd say that's relatively common for firms of our size and strategy. So the Series A, B, C, D firms are kind of holding on new investments and looking at a lot of existing portfolio. But I've been talking to a number of seed investors, and they are still very much open for business. Seed investors and angels, people that aren't leading rounds, maybe doing party rounds. A lot of those people are still, I talked to a guy this morning who deployed a check this week. And those tend to be faster processes, right? If you're raising $1 or $2 million from 10 different, seed firms or angels, you don't have the level of diligence. You're not, taking on a director role. So there's kind of, it moves faster typically. So I would say for early stage entrepreneurs that are raising seed and angel, maybe not this week, or I'd give it a few more weeks, but I think, next month, May, June, July, we're going to have to figure this out. And it'll start with the seed investors actively making investments. It'll move to, A, B, and C stage. So there's still a lot of dry powder.
I mean, well, and that's the other thing is that institutional investors with a typical 10-year fund have to continue to invest capital. They only have 5 years to invest. And if they want to be in line to get their next fundraise, they have to have a certain amount of capital deployed. So firms might be able to wait 3-6 months, but they can't wait a year potentially if they're in year 4. So there's still going to be people having to put money to work. And so there will be investments. There's going to be opportunities to raise capital. I started my first company in the last recession. When did you start Exit Round? Was that about the same time?
Yeah, it was 2013, but we did one in 2008. We did one in 2008 also. And so, yeah.
It's a good time to be creating a business, to building a product, maybe less of a good time to be taking a product to market.
Yeah.
But it's not a bad time to continue to build businesses. Are there any sectors that you're excited about versus just trying to avoid a bloodbath?
Yeah, totally. I mean, I'm biased because we tend to focus on enterprise software. So I'll talk about that first, but then I'll talk about some other sectors. But we think actually opportunistically investing in enterprise software right now is pretty interesting. Not only are those companies holding up better in public markets to kind of set a high watermark valuation, but if you look at the economics of these businesses, they have very low capex. Their opex is elastic based on markets. Very high margin businesses, recurring revenue that once you sell a customer once, and if you have a good product, you're going to have 95+% retention rates. And so we believe that that's a really right place to be investing. That given the kind of COVID market we're in, we're all future of working, we're all Zoom conferencing, we're all figuring out collaboration tools. I think that's pretty interesting. So that's certainly an area where we're pretty excited about. But one of the other areas that I think I've been interested in a while, which is totally random and on the consumer side, is gaming. And I have a quick, I was going to share my screen really quickly here. I saw a chart yesterday that blew me away. It's from the New York Times. And it was essentially where the article is how the virus transformed the way Americans spend their money. And you can see all of the traditional categories falling off a cliff. And then you see actually where people are spending money. And over to the right here, you have online grocers. That makes sense. But then right next to that, you have gaming. And I looked at this and I was like, wow, if this is Maslow's order of hierarchies in 2020 in the COVID world, that's super interesting. Gaming generally has been an interesting category that's been coming back into kind of the investment world. Specifically massive multiplayer online games where it's very social experience, people come together, infinite worlds where you can continue to grow. And then there's a ton of actually in-app transactions. So gaming is a pretty fertile area that we'll start to see. Interested in future of work. I think the realities I've spent kind of a couple of years ago, spent a lot of my time in the virtual and augmented reality space. Chris, you and I connected on a lot of that stuff over time. And I think this is probably the biggest social push into the realities where people are looking for new ways of interacting with people, but from a really remote distance. And, I've spent a lot of time in VR. I think you have too, Chris. And, what's different about virtual reality than what is in a Zoom conference is Zoom, we're having the conversation and the information is getting across. It's a very IQ conversation. But in virtual reality, when you're in a physical place with a person, there's a tremendous amount of EQ that comes across. There's emotional parts. There's body language that comes across that actually creates that human connection. We had a short board meeting with one of the VR companies I'm on the board with. It's a gaming company earlier this last Tuesday, and me and the two founders were in VR interacting, and it felt like we were actually in the same room. So I think we'll see a lot of attention back into VR and AR, potentially blockchain as well, given the how much fiat currency is going into the ecosystem. Could be an infinite supply, though though it shouldn't be. That may drive a lot of interest into cryptocurrencies. So, those are a couple of the areas we're interested in, but I think, what are you looking at? What do you think?
Well, the way I'm looking at it is there, what technologies right now are getting adoption that would have taken 2-3 years compressed into 2-3 months. I mean, we're on Zoom right now. They went from 9 to 200 million users. That's pretty self-explanatory. But VR for employee training, for hiring. We've gotten a couple questions about, would you ever invest in a company that you never went and actually saw face to face? How would you hire somebody for your firm, either your venture fund or your company, right? These are things that everybody has to do, and maybe technology is going to be able to do that remotely.
Yep, so true. Actually, recently we've seen a couple of companies that are focused on kind of virtual desktop type whiteboarding situations where, again, on Zoom, you can get a point across and you can send an email or you can be in a Google Doc. But how do you be a little more collaborative in that? How do you, have a whiteboard creative session over something like Zoom? We've been seeing, we saw an interesting application interface where in any it's a plugin that in any application, you can see where your other coworkers are at. So like in Google Docs, how you see where they're typing and clicking, you'd be able to see that in any type of application. So it creates a more social experience. But totally agree. There's going to be a huge amount of collaboration and presence tools that are coming.
One thing I wanted to address, we talk a lot about, what do investors want to do, but what about your limited partners? Are you getting any feedback from them on, what they're expecting you to do? Because for people that don't know, limited partners typically don't have a lot of say in what you do on the day-to-day, on your investment decisions and things like that. That's left to the general partner and the investment committee. But they can give you indications on, we think your pace of investing should slow down or, or pick up or whatever. What are those discussions,
Yep.
To the extent you can actually discuss?
Yeah,
them?
definitely. Yeah, I mean, we have, as VC, we have two customers. We have the entrepreneur and then we have limited partners. And ultimately it's the limited partners who, it's their capital we're investing, they're the ones entrusting us to be good fiduciaries, but also return them multiples of capital. So, we were very quick to reach out to all of our existing investors at the beginning of the COVID, as the COVID really started to take over the US, the dialogue and the economy, shelter in place orders went throughout. So we were pretty proactive in going to our limited partners and first telling them that we are paying very close attention to it, that our team is, not traveling, that our team is working from home. And then we walked them through, primarily in an email, what the planning exercises we're doing. And a lot of those are the same planning exercise that we talked through at the beginning of the session, but just kind of letting them know how we're approaching this. And then we just said, call us, if you have any questions or specific concerns. In a couple of cases, we've had some limited partners reach out. We'll definitely jump on the phone with them, talk through any issues or questions. For the most part, we've been finding though, a lot of the LPs, a lot of our LPs are institutional money managers. And so they've largely been dealing with the hair on fire public equity markets and bond markets. And so we kind of, we haven't sent them too much information. We don't want to deluge them. We don't want to try to get too much of their time because they're very busy. But, we want to be attentive. So we'll see. We've had a couple of people reach out and say, hey, this actually looks like a pretty opportunistic market, which we agree. Not only valuations are down, but I think companies will build really interesting, solid fundamentals in this type of a market. I was on a Zoom call last week, and actually Bessemer Venture Partners put it together. It was a really awesome call. It was the founder of Pinterest, the founder of Shopify, and the founder of Twilio. And they were all talking about when they started their businesses, which was 2008 timeframe. And they were talking about how the economic situation caused them to contract, basically not waste any money and focus everything on product that drove real revenue. And by needing to be focused on that, it created great business fundamentals that then created very healthy businesses that emerged. So, I think this time will offer that. And then, thanks to a lot of the economics of what software SaaS type businesses have with recurring revenue, we're pretty excited about the opportunity ahead. So, we'll see, but we're paying attention to LPs as much as possible.
Great. I mean, to that last point, Jacob, so many amazing companies were built in the last recession cycle. And so it's very reasonable to expect that to happen again, even though the fundamentals are very different for why we're in it right now. But before we get into the Q&A, I'll just leave you with one last question for myself, which is, what do you see as the role of tech? And really I'm referring to, big tech in combating the pandemic. And if you have any good examples of companies, I mean, Google and Apple just collaborated, which is kind of a crazy thing to say, on the contact tracking, right? That's a great example there. Anything else that you're seeing that's impressive?
Yeah, I mean, I'm heavily biased, but I'm long big tech or long tech generally. I think, the ecosystem of entrepreneurship, and it goes beyond tech for sure, but the ecosystem of entrepreneurship is one that engenders optimism, problem solving, and being able to blow through walls. And those are key things we need right now. And, whether that's 3D printing, pieces for ventilators, or using Sway to get more, personal protective equipment, or that's building software and algorithms to crunch data in a more effective way to do contact tracing. I think all of these are within the realm of, tech. And that's more to the point of, tech is just becoming more, it's not a sector anymore. It's actually, a medium through which solutions are done in every business, from food manufacturing to, data science. And so really positive on that. I think seeing what Google and Apple are doing is really interesting. Seeing how they're approaching the contact tracing solution without data, with keeping data privacy as paramount is really interesting. And so I don't know, worth saying for just a second how they're thinking of doing it, but pretty interesting. It's interesting. In China, what they're doing is less personally, it's very much personally identifiable. In China, what they're doing is essentially attaching people to a unique identifier and then asking them to swipe that identifier everywhere they go, so that every place they go has a record of where they are. And the government can essentially track that. What Google and Apple are suggesting, excuse me, is that we use the Bluetooth beacons within each of our phones, which are not necessarily personally identifiable. They can be hashed using very common cybersecurity methods, but using these hashed identifiers to be the node and the mesh network through which people know if they have been if they have been around or in contact with someone who has COVID-19. So what this would do is and this would be at the option of the owner. This would not be a government mandated piece, but anyone with an Android or an iPhone, essentially, if let's say I was diagnosed with COVID-19, I would then go to my phone into a menu and turn on that I've been affected with it. Again, I, the owner, own it. What that would do is then send a beacon out to the entire network of Bluetooth devices that were within 6 feet of my Bluetooth device over the last 14 days. And so that's pretty interesting, is that you don't need PII to go to cross. You're just using hashed Bluetooth identifiers, but that you can alert people to go get tested themselves. So I think that's fantastic. And I think there'll be more data science and ways of identifying where you've been, as well as helping solve the disease. So, I'm long tech and love to talk more about it.
Sure. I think we'll see a little bit, we'll see tech in a different light at the end of this.
Yeah.
So I'm going to move it into the Q&A section.
Cool.
And I'll start out with a question from Mary. She said, do you have any advice to people who want to join a SaaS company right now in this economic environment? And I think you can extrapolate that even broader if you want. How do people go about looking for jobs in this environment?
Yep, great question. So to that point, and actually maybe I'll share my screen one more time with some resources, because on there's a link. So at Shasta, we're totally focused on helping our companies. If you go to shastaventures.com/insights, there's a post called Talented People Available, and it's essentially a reverse job board. It's a resume board. So as there have been a tremendous amount of layoffs, there have been lists of people who have been laid off that are now being posted openly. And so we have aggregated a number of those. We update it on a daily basis and enable people to go kind of click through those and find people that are looking for roles and hiring, trying to help encourage the rehiring of great people. So that's one way. The other way, or a couple other ways, the large companies, Apple, Google, Microsoft, Facebook, are very much still hiring. I talked to a recruiter at Pinterest the other day, and she said she's never been busier either. So I would say, if you're interested in a large company, start looking at those and applying. Also, the large public SaaS companies, they're also hiring. We have a number of companies in our portfolio that are hiring. My email address I put on the screen, but it's jacob@shastaventures.com. I'm totally happy to talk to anyone. And if you're looking for a job in a SaaS company, I'm happy to connect you with any of the companies in our portfolio who are actively hiring, because there are many. So this is, early on, we saw this as an opportunity to really help solve the market for people looking for jobs.
All right. Thank you, Jacob. This is from Adam. How do you see the prospects of fundraising for companies which are pandemic proof? Say for cannabis, right? Sales are through the roof.
Yep.
For telepresence, telehealth companies,
Yep. Very strong for those companies. Great market for fundraising if you're seeing growth in this market. Today Shasta is totally focused on enterprise software, but prior to our current focus, we've done a lot of consumer investing. We have a number of consumer companies in grocery, in telehealth, in connecting kids and parents in virtual classrooms that are just skyrocketing right now. There are a lot of growth stage investors that are interested in those businesses. One of them just got 3 term sheets this week. So the markets are very hot. We had another company in indoor fitness who just got another term sheet that is oversubscribed that round. So if you are in a pandemic-proof business, you're very fortunate, and it is a great market to invest. Depending on the stage of your business, if you're 10 plus million in revenue, I'd be approaching a lot of the growth stage investors which is where a bulk of the capital has gone over the last 2 years from an LP perspective. So it is a very good market to be in if you're growing right now and you can raise money.
Agreed. This comes from an anonymous attendee. What do you look for in terms of ESG factors and data? I think that it's really easy to overlook those sorts of things when you're in self-preservation mode, but they're no less important. So, folks like BlackRock and State Street are still calling for disclosures, doubling down on areas despite the current context. Is this a non-issue given the companies are all private?
Yeah, really interesting. Great question. It hits close to home. My wife's actually at Berkeley finishing a Master's of Development program, totally focused on ESG. She's been in ESG for 15 years. So I have learned a lot of ESG through her, let's say that. At Shasta, we don't have a specific ESG focus or lens. We probably should, but we don't today. What we're looking for are obviously good corporate and social citizens. We look for diversity in teams, in diversity of founding groups, in the well-roundedness of customer bases. We are looking for good humans. And at our stage of the business, which is, it's special to early stage investing, is that you are really investing in a person or a couple of people who are going to lead the business through. And in order to do that, you need to have a high degree of conviction that you just trust them. And so, innate to my own decision-making process is finding people that have a lot of the qualities that ESG screens would have. ESG screens I think of are, you're right, at like a public equities or mutual fund level where you can kind of see metrics. We look at them on more of a human level. And so, one of the things I'm worried about, which is back to how do you make a new investment over Zoom, where you're taking a director role and you're really almost getting married to the company. How do you have that level of comfortability with founders or with a team that they do have, that high level of social awareness and ESG type characteristics? I don't know that, and I think we'll work through it and we'll get there. But Chris, do you have any ideas in kind of what you've seen?
Well, look, I think just fundamentally, the more diverse a team is, the more successful they'll be. You need ideas coming from disparate backgrounds. I think that's where the most success is. So I think investors are doing themselves a disservice if they're not backing diverse teams. I do see that there might be a larger impact on, say, female-founded businesses throughout this. There were some kind of very high-profile companies like Away that went through founder issues. But do those get exacerbated in this environment? I worry about that, and I think it means the directors and shareholders, particularly the institutional ones, need to be hyper aware and more engaged to make sure that that doesn't creep in.
Mm-hmm.
Mm-hmm. All right. Pyeongping, is this a good time to start a company now or in the next year or two?
Ooh, good question. I think it's probably a pretty good time to start a company. I think getting seed capital in the $1 to $2 million range is pretty doable in the next month or two, and will continue as we start to get a better sense of what the economic environment will be. As I mentioned, I've talked with a number of SaaS investors, but also just seed investors, over the last couple of weeks, and it seems like seed and angels are definitely still deploying capital, looking for new opportunities. And in those cases, and so I'd say, yeah, it's probably a pretty good time. Your competition is going to be less. You're going to have to stick to the fundamentals. I would say if you raise money, plan to go for 2 years on that capital. But if you can build a business and, be in a good place to start accelerating growth in 12 to 18 months, that's a good spot to be.
I agree.
As an entrepreneur, there's no better time than now, right? So.
Everybody has a lot of free time, or more free time than they used to have. And if you do raise capital now, it's going to be pretty expensive. So take this opportunity to build a business or come up with an idea and find your founders and start building, so that when things return to normalcy, you'll be well positioned to capitalize on it.
Yep. Also, there's a lot of open team, hiring candidates out there today. So
Great
in a market, having a job, is a big deal. So I would say, take advantage of that and use your equity and be able to bring on some great candidates.
Well, you have a lot of potential co-founders out there. Absolutely. Okay, here's this question. Will the nature of jobs at startups shift to more freelance part-time roles? And I think you can also elaborate on kind of the accelerated shift to working remotely in general.
Yeah, I think so. I think there will be a big shift to remote work, free time. I'm sorry, not free time. Just kind of ability to use your own time, flexible work schedules. Over the last 2 weeks, I've talked to 3 different companies building marketplaces for remote work. And as a part of that, you could be a full-time worker, you could be a part-time worker, you could be a consultant. So definitely, there's going to be a huge uptick in that. I think also what companies are realizing is that people can be incredibly efficient from home. And it is taxing in a different way. It's mentally taxing. It's taxing with families and with children. But you may not necessarily need, the large commercial real estate footprints that a lot of the companies have today. And so that will increase the ability for remote work big time.
Absolutely. I think people are realizing that a lot of those meetings could have been done over Zoom. You don't necessarily have to get on a plane and fly across the country to have an in-person meeting anymore to accomplish and the same sort of thing. So that's one of those trends. I think that this didn't create the opportunity, but it's accelerating the adoption, and that will have a long-term impact on our behavior.
Yep.
Absolutely.
Yep. Totally.
Nina asks, would you consider the more pandemic-proof companies overpriced to some extent, given that demand might decrease in the future?
Yeah, it's a good question. The companies that we've been seeing raising big rounds have super high retention rates. So we're kind of hoping that those retention rates hold. Maybe there will be a downtick, yes, but one of them's in grocery, one of them's in dog food, and both of those are things where I think we may see fundamental shifts. Like, people just probably aren't going to want to go to grocery stores a lot anymore, or the shift into online delivery and e-commerce is meaningful and may not go away. It's going to be a step function. So yes, there will be some declines. From a valuation perspective, the valuations, they're not orders of magnitude bigger than they were. Like, if these companies were experiencing the same growth in a pre-COVID world, the valuations would be off the charts. These are much more reasonable in comparison to their last round valuation. But so yes, there is a tempering of them. But we will see. And most of these are at a multi-$100-million valuation stage.
Right, sure. It definitely depends on what stage they're at. But also, it's important to keep in mind that private company valuations typically lag what's happening in the public markets. We took at least 9-12 months in 2008, 2009 for private valuations to come down to be more in line with the public markets. One thing I would advise is that just as it was pre-COVID-19, look for companies with strong fundamentals. It's probably not a great idea to look for the quick hit, because it'll be just that, and you'll be back to not really having anything valuable at the end of that. So we'll go with, I think we have 5 more minutes. Jacob, is there anything that you want to end with? Any parting thoughts that you have?
Not particularly. I mean, I think it is a really good time to be building a business with a low burn rate, and so figure out how to get there. It is I'm going to share a couple of these resources. Like I said, our whole thing at Shasta is partnering with founders at the earlier stages and helping them think through building their go-to-market strategies. And so a couple of my partners hosted a webinar a week ago called Managing Your Startup in Uncertain Times, where we had 4 founders who had to do some pretty serious cuts to their business over the last week or two, talk through how they did that. How do you lay off 70 people over Zoom? There's a founder on there that talked through that, and in a way where he was getting positive, responses from employees as much as possible. But thinking through, economic contractions. One of our partners is a guru in SaaS business models. He wrote a post about, sales priorities for your startup in the COVID-19 world. So these are kind of a few of the core resources. And then again, my email address is on the slide here. I'm happy to chat with anyone and, either help you connect with companies if you're looking for a job or think through financing. But, we will get through this and just think about positioning yourself for the long run.
Sure. I think this is a important time for the venture community to be pulling together and helping the whole ecosystem out. That's our mission at Accelerate Yale, is trying to pull together the entrepreneurial ecosystem. We're here to help. Jacob's a great resource. We are as well. You can always reach out to us. We've got a LinkedIn profile, Facebook, a YouTube channel where all of these webinars have been recorded and will be uploaded. And I want to thank everybody for your participation in today's webinar. Jacob, huge thanks to you for your time.
Thanks for inviting me.
Really look forward to having the opportunity to doing this in person in the unknown future. But until then, wish everybody happy and healthy rest of the week. Thanks a lot.
Awesome. Thanks, Chris. Thanks
all.
Thanks for being here, everyone.
All right. See ya.